and welcome to this Bitesize Technical video on net pay. Net pay is a method of receiving tax relief on contributions that can only be used by occupational pension schemes. That is, pension schemes established by an employer for the benefit of their employees and by public service pension schemes such as the local government scheme. Where the employer is operating the net pay arrangement, then the employee's personal pension contributions are deducted from their gross pay before tax is calculated under PAYE. This means that under net pay, full tax relief is given up front, so a higher and additional rate taxpayers will get relief at the amount paid without having to claim back the extra tax relief via self-assessment. It also means that all the tax relief goes into the pension. This is in contrast to the alternative relief at source method, where only basic rate relief goes into the pension, and any relief above this is claimed via self-assessment and paid to the individual personally. Where the employer chooses to operate net pay, all members contributing to the scheme must use the net pay method. It isn't possible to have some using net pay whilst others use relief at source. Let's look at an example. Lily has an annual salary of £90,000 and makes monthly personal contributions of £2,000. This means her monthly gross pay is £7,500. However, under the net pay arrangement, her employer deducts £2,000 each month and pays it directly to the pension scheme, which receives the full amount. Her employer then operates PAYE on £5,500 each month rather than £7,500. This means Lily will pay £800 less tax each month on her salary. The table shows that there is £2,000 less pay falling into Lily's higher rate tax band, resulting in a total monthly tax deduction £1,152.63 rather than £1,952.63. In contrast, if Lily were to make a contribution to a relief at source scheme out of her take-home pay, she would pay in £1,600. The scheme would claim £400 basic rate relief, and she would claim the extra £400 via self-assessment. For those that pay tax at a rate above the basic amount, net pay is the advantage they get all the tax relief immediately and don't have to wait until the end of the tax year. However, there are losers at the other end of the scale. Under relief at source, all contributions receive basic rate tax relief at 20%. This includes contributions for income when no tax has actually been paid, i.e. those that come from income within the personal allowance. Under net pay, no tax relief is given on those contributions, so low earners lose out. The government are putting in a process that low earners under net pay will be able to get this relief. However, the first claims cannot be made until the 2025-26 tax year relating to contributions paid in 2024-25. It's also likely that low earners will have to apply for the relief rather than it be granted automatically. A couple of last points to note on net pay. Sometimes net pay can be confused with employer contributions as the payment comes via the employer. This is not the case. They are still classed as personal contributions. It is just that the employer facilitates the payments through payroll. Importantly, as they are personal contributions, national insurance is still payable by both the employer and employee. This is a key difference with salary sacrifice. Salary sacrifice is where salary is given up in lieu of pension contributions from the employer. These therefore are employer contributions and do not attract national insurance. If you want to know more about how relief at source works or employer contributions, look out for our separate bite-sized videos on these.